Hold on. Okay, cool. Continue. All right, so guidelines and disclaimer, pretty much. We are not fiduciaries or financial advisors. Everything we say today is for entertainment purposes and our opinions only. Do not take what we say as law or as a reason or a means to actually spend your money on something. Take it as education to help you get better in your investing world and your journey. So with that being said, I am going to pass it off to Sean, who will be doing today's brief. And Sean, you have the floor.
What's up, everyone? Just hope everyone's doing all right, and thank you for stopping by and tapping in tonight. I just wanted to go over something a lot of people might have questions about, or something that I've been hearing a lot about, is the understanding the intrinsic value to find the value in the stock, to check to see.
We're going to look at this and just say, okay, hey, this is just pretty much a speed bump in comparison to where the ultimate goal is.
Can we get someone to mute their mic, whoever that is? Yeah, just to try to find intrinsic value for a stock to get undervalued or overvalued.
We're just really talking about the picks that we've already picked.
Did we get that muted over there? All right, cool.
Yeah, we're good. Go ahead.
All right, so I'm just going to share my screen, just go over a little bit about finding the intrinsic value of a stock. And this is pretty much going to kind of detail and just go over briefly the discounted cash flow method. And it's a bunch of different other methods and ways to find it. You got Graham intrinsic value formula method. You got the EPS multiplier method. And there's a couple of other methods that out there that you could use. But I just personally chose to do this one because it's actually on TD Ameritrade, and it helps me grasp the intrinsic value idea a lot better. But before I start, I just want to say, before you even decide to find intrinsic value, decide whether you're going to purchase a stock or whatever, just please just ask that you get a grasp and understanding of the fundamentals, and just take your time with it. And the stock market's not going nowhere, so you don't have to be in a rush. Just to get a real understanding of what the fundamentals are of a business, how they operate, and things of that nature. So that being said, I'm just going to share my screen. Yeah, so what is intrinsic value? It's a perceived value of what a company is worth based on the future earnings a company is expected to generate. Usually it's determined via quantitative, qualitative, and technical analysis. Throughout the quantitative analysis, you pretty much doing the fundamentals and getting all the ratios and the metrics of the business and the fundamentals. And in a qualitative analysis, you're just, looking in the specifics to the business model, management, governance, and the industry performance. And technical analysis is pretty much going over the charts and looking at all of those things. Using those three factors to determine intrinsic value will help you understand how a company generates its cash, to cancel out any feelings and emotions you may have, what the stock or what somebody else is telling you. Cancel out the hype of a stock, and having the fear of missing out. It also reduces the subjective perception of the stock. Why do investors use the intrinsic value? To determine if a stock is overvalued or undervalued is pretty much what it really does for you. Overvalued, the current market price is higher than or close to the intrinsic value. Undervalued, meaning the current market price is lower or well below the intrinsic value. And one of the models that I'm going to talk about tonight, the one that I usually use, is the discounted cash flow, the DCF. It's a valuation method used to estimate the value of an investment based on its future cash flows. It It applies a growth rate to estimate how much the value might increase over time. It also applies a discount rate to account for risk, and it indicates how much a company's future growth is worth now. Yeah. The DCF valuation method uses the EPS, the earnings per share, as a growth rate metric. It uses projections, forecasts, and industry averages for historical growth rates. And right here, just detailed a little graph just to show you how it kind of projects, a little illustration. And in the green, you'll see the historical EPS, what is done in the past. And you have the projections of the EPS, the earnings per share for the future, which allows you to give a forecasted EPS of what your earnings potential may be. The DCF valuation method uses the industry average PE ratio. It's used as a common exit multiple in a DCF valuation method. It's the amount someone might pay for a stock in 5 years for every dollar of earnings after that. It also provides a good estimate of what investors are willing to pay for the earnings per share growth in the future. The discounted rate that's applied to the DCF, it illustrates the risk of owning a particular stock versus the opportunity of investing elsewhere and somewhere else. It's DCF, the discounted rate is referred to as expected rate of return. It accounts for the risk over time, and also includes a theory of time value of money, TVM. The money is basically a theory that says the money that you have now is worth more than the same sum in the future due to its earnings potential. So if someone was to ask you, would you take this dollar now or would you take this dollar later? Most people would probably say take this dollar now, because the dollar, you have the potential of putting it out there to work for you and gain interest on earnings, as opposed to waiting till you that determined date where you would get that other dollar. DCF valuation method uses the capital asset pricing model. Some people may have referred to it as the CAPM. It's a way to calculate the stock's discount rate to realize the rate of return. And the expected rate of return right here is just a little equation to help you get an idea of it. I know this might look kind of confusing, but I'm gonna break it down later on just to give you an idea of how it's illustrated and how you get the rate of return. And then later on, I'm gonna give you an example of the worksheet and just go over a couple of things inside the worksheet to help you understand this little equation right here. So, I put the equation at the top so you can just follow through with the top. The risk-free rate of return is a baseline rate investor might expect to receive for investing in a risk-free investment. What's that right there? Long-term investors use the annualized yield on a 30-year treasury bond, ticker symbol TYX.X, and it's just tracking the annualized real of the 30-year treasury bond. And that's kind of like the bottom floor that an investor would look at for their returns. So it's not something that's going to be really actualized at the time that you're looking at it. The market return is the average return of a market index like the S&P 500 index. And that's pretty much used as a benchmark for the overall market, is the S&P 500 index. You also have the market risk premium, which is up there. And then you have that's just adjusted for individual stocks volatility, and is calculated by subtracting the risk-free rate from the market return. Beta up there measures the stock's volatility risk compared to the market as a whole. So if beta is greater than 1, it means the stock is more volatile than the market. If beta is less than 1, it means the stock is less volatile than the market. And since the S&P 500 is a benchmark for the index, the S&P 500 has a beta of 1. So if you're at 1 or below 1, that means you're doing pretty well as far as the volatility rate. Now, I just wanted to find out if you guys are following along, if you can, if you can look at the equation right there and just do the math and let me know, put down in the box and let me know what you get for the rate of return. If you look at the equation, it's the risk-free rate of the 30-year Treasury yield. That was something I actually picked up or pulled up today. Give me 1 second. Let me find out where I pulled that up at. I usually go to macro trends, and you can pull that up on the interest rates, and it'll give you the different bond rates right here. So as of the 20th, when the market closed, it was at 1.38%. So that's where I got that number up over here for. And the S&P 500, get out of there. And the S&P 500 index annualized returns 8%. And I just chose a beta from, I just put 1 in there. You could put any other number in there if you wanted to. But if you can let me know what the annualized rate of return would be.
Sean, hit from current slide at the top.
Oh, yeah. But is any, I couldn't see what was in the message box.
I got it up. I'll let you know.
Did anyone care to put in a number in there for the rate of return? If you just subtract the RM from the RF.
Somebody said 9.38.
What'd they say?
9.38.
Nah. Anybody else? I mean, what you would do first is subtract the
So
S&P
it'd be
500 index annual return at 8% minus the 1.38%.
so remember, it's like, please excuse my dear Aunt Sally. So parentheses,
Yeah.
exponents, multiplication, division, addition, then subtraction.
Yeah, I just needed somebody to check my math.
So here, let me
Anyone
do it.
else put anything in there yet?
1.39.
Nah, I got 7.62%.
7.62. Somebody else put 7.62.
All right. We good on that then. Now, once you get all of that stuff done, you want to check out the margin of safety, referred to as MOS. Margin of safety is the difference between your estimated intrinsic value and the current market price. I know a lot of this might not make sense right now, but at the end, when I do the example, you'll get to see where all of these numbers go into in the little cheat sheet. But yeah, the margin of safety is the difference between your estimated intrinsic value and the current market price. It provides a cushion against errors in analysis or calculations and allows an investment to be made with minimal downside risk. So for most investors, they usually go with the anywhere from 25 to 50% margin of safety. Some might be higher than that, some might be lower than that, but commonly it's looked at as 25% to 50% of margin of safety. And this is one of the examples. I just threw in some numbers in here for them to show you the margin of safety and how it's calculated.
Hey, Sean.
Yeah.
Real quick.
Uh-huh.
Somebody said, what's on, can you go back 2 slides? Somebody said, what is the risk premium?
The risk premium right there up at the top, that is just adjusted for individual stock volatility. It's calculated by subtracting the risk-free rate, which you'll see up here in the green. Or actually, just look at if you see the top up over here, the market risk premium is just an adjusted rate for the volatility. It's calculated through the free risk rate minus the market return. So that would be the market risk would be 8%, which would be right here, and then you would have that minus by 1.38, which is the risk-free rate, which would be right here, because you're going to use this number actually twice, the risk-free rate, because you're going to put it in here and you're going to put it in here.
And then once you get that number, you'll multiply that by the beta.
The beta, which would have been 1. And then you just add that, whatever you got right here, by 1.38%. And that'll give you the expected rate of return.
Thank you.
Now, the margin of safety is just an example right here. So let's say you did your fundamentals and you did your calculations and you determined the intrinsic value for a stock was $100. And you saw that the current price was 25, you would look at that and do the math and you come up with the margin of safety of 75%. Now it's I just put up 2 ways you can come up with the margin of safety, which usually is this one right here. The margin of safety equals 1, which is just like a beta that they threw out there, minus the current price divided by the intrinsic value. So you would do 1 minus 25 divided by the 25, the current price, divided by 100, the intrinsic value, which give you 0.75, which is 75%. Or you can do it the other way, which is the intrinsic value, 100 minus the current price, divided back again by the intrinsic value, which is 100. And you get 75%. So it's 2 ways you could just do that right there. Does that make sense? And like I said before, most investors will look at 25 to 50% margin of safety. So if you had say you was looking at margin of safety 25%, this intrinsic value that you came up with is within that margin of safety of 25%. Now I'm just gonna pull up the worksheet right here to show you guys how it would come out.
Hold on real quick.
Go ahead.
Does anybody have any questions so far? All right, cool.
And for those of you that have a TD Ameritrade account, this worksheet is in there inside the account. And I don't know if any other brokerage has an intrinsic value calculator. I'm pretty sure they may have, but this one I just pull up right here. And all of those terms that I just came up with in that slide, they're all in here and kind of give you the meaning of what they were. So once you put them in, you know where to find them at. So is there any stocks that someone might want to look up and find intrinsic value on just based off of this? This is like not regarding the fundamentals and stuff, just to look at. Because I did one, I just don't know if you guys want to do that same one. But you know what? I'll do that one. Let me pull it up. So Marvel.
They said Square, XLY.
So I'll do Square. You start here and pop in stock symbol. And the EPS growth rate, which is that growth rate, and it's usually done for 5 years out. It's a common estimate to the growth for 5 years out. And you can find that on TD Ameritrade, or you can go to Yahoo Finance and look under the, was it the analysis? And you look down here, it'll give you the next 5 years per annum estimated growth rate, 35.59%. And you just take that, pop that into the thing. What was it?
30.
35.59.
Yeah.
And it'll populate in here, and the calculator does an automatic reduction to reduce the projected growth rate, so it's not too high of a number, and it kind of makes it standardized. So the growth rate would be 27.58, and then you want to find the industry PE for the current year, and you could find that. I didn't find it or look it up under Yahoo. I found it under FinViz. They have a section in there. Was it under groups? Price to earnings. Where did I find that at again? There we go. I think this is where I found it before.
It's not funny, okay?
I can't even find this joint. Give me 1 second. Let me find this real quick. I was gonna put it in through a Ameritrade. Was it SQ? Yeah, and TD Ameritrade, you can find it up here, but I forgot where I found it under FinViz. And industry PE would be over here, 54.38. Then it'll give you the reduced projected PE to 38.1. And then that other ratio or equation that I was showing you before with the expected rate of return and the ROR, the beta, and the market risk premium. So for here with Square, you would plug in the beta. For Square, beta is right here at 2.7. And here for the market risk premium, they would just in this equation or this chart, you would just plug in the volatility rate, which is the VIX, and you can just pull that up also right here. That'd be 22.54. And then here is used as the treasury yield. So you just plug that in. You just put the symbol in for the treasury yield. $13.53.
Hey, hey, Sean.
Yeah.
After you finish this example,
Uh-huh.
Can you show where you actually found the worksheet in
Okay,
TD?
yeah. I'll do it.
Appreciate it.
I think if it'll come up. Well, I could actually just put a link in there, and then it should be in the link. But I'll do it after this.
Okay.
Yeah, the current stock price, which is for Square 155.10 at closing. The stock EPS, and it used the trailing 12 months EPS. 0.45.
I saw where you got that number from. Can you show them where you got that number from?
Which one?
That 0.45.
Okay. Right here on TD Ameritrade is right here. The EPS trailing 12 months gap. And on Yahoo Finance, you can probably find it in the summary as well. But they're gonna have two different numbers sometimes. Because one is the what is
Gap
it?
and non-gap?
Yeah, the gap and non-gap. Yeah, for the years of projected growth, you usually, if for long-term investors, usually you're looking at 10 years. So I usually put 10 years in there, and you would come up with intrinsic value. It would be off because the price of the stock is way up there already. So your margin of safety is looking real terrible right now. But
So what does
that
that
doesn't
mean for the stock?
necessarily say that again.
So what does that mean for the stock if you
That'll
were to look at that right now?
that'll pretty much tell you that it's overvalued.
Okay. So this would be if you were looking in to get in on Square for long term.
Yeah.
Right now, you would hold off on it.
Yeah, exactly.
Which one do you prefer to use? Are you talking about TD Ameritrade or Yahoo Finance? That was a question in the chat.
What they said?
So which EPS do you prefer to use? TD Ameritrade or Yahoo Finance?
I usually go with TD Ameritrade since I'm already in here, and this is from their calculator.
Okay, perfect. Can you do this with ETFs as well?
Nah, this usually is done with individual stocks because of the beta. You really you're not able to get the annualized rate of return due to the beta and the discounted rate. You're not able to really pull that off because you have multiple stocks. And some of the stocks might also be out of not out of an industry, but in multiple industries, in one sector, but in multiple industries.
Okay, so if you wanted to try to find whether or not a ETF, and this is just my thought process, right? If an ETF is good right now, probably take your top 15 holdings in the ETF and see how they're performing, how each individual stock is performing, whether or not they're overvalued or undervalued, whether or not if they're going to probably drop or fall pretty soon. Because I'm guessing if something's overvalued, it's going to fall eventually, correct?
Yeah, absolutely. But and that's the thing of with the ETFs, you would have multiple stocks in there, and some of those stocks, say like your top 15, might be carrying your bottom 15 stocks, and or your top 10 might be carrying your bottom 5 stocks. So it really depends on how much research you're trying to do within. You're gonna put in 15 to 20 different stocks in there just to determine whether ETF is overvalued or undervalued.
Mm-hmm.
I mean, you can. It's probably other ways, better ways to evaluate the ETFs, but I'm not really too sure about that. But I mean, it wouldn't hurt to try it that way.
Okay. Any other stocks y'all want to look at? Can you do NVIDIA? Do CPRT first. You put S.
Should I just do 1069? $169.
169 cents.
See something. $2.8.
Is this something you do every time before you get into a stock?
Nah, I usually do my research on the financials first, the balance sheets, the income statement, look at the debt, try to pull out the 10Qs, 10Ks. And also try to figure out a research. If I don't know what the actual business model is or what the business actually does or how they make their money, I would pretty much look into that, because you want to know how they make their money, and because that's pretty much what's going to determine their earnings and their revenue. And if there's any issues there, then you might as well not even look any further. Now these numbers are going to stay the same right here. The VIX and the 30-year yield rate. Yeah, PE. He's looking for Copart.
Will this work for REITs?
Yeah. Industry 96.70. Wow. EPS growth rate. Now, sometimes some people would take these two numbers and do the average of them, but I usually it really doesn't specify that. But you can't. That's something else you can do, but they don't really ask you for that. The average of these two instead of just going with the next 5 years, because if you've seen what they've done in the past as opposed to what they're doing in this current 5 years, you get an average of those two. It'll probably give you a better graphic of what's going on, or projecting what's going on. Oh, was it 22? 30. 18. 18 to be. Yeah, now see right here, you look at Copart. They have the intrinsic value that they came up with after plugging in a lot of information was $269.49. Current stock price is $169. This gives you over the projected growth rate over the next 10 years, assuming everything stays on pace. Margin of safety 62.6%. So if you were in that that range of safety, your margin of safety was 25% or 35, 40, or whether 50 or even 60, you're still within that margin of safety to give you that cushion to where if the stock even dropped, if you got in and it still dropped 20%, you're still okay. You still have a 42%, or 20, you just drop 40%. You have a 22.6% margin of safety still. So estimated within the next 10 years, that would be the 269.49 would be the value of the stock. Does that make sense? Now, you don't just want to use this right here to go in and determine whether you should buy a stock. You still want to look at the fundamentals and learn about how they make their money and stuff like that.
Yeah, I was about to say that because looking at this, saying, well, shoot, I get in now. I can make in 10 years, it'll go up $169.
These are
I'm
all now.
good.
See, these are all assumptions
Right.
on an estimated growth of a stock and what it's going to be worth 10 years from now. So that doesn't mean that, something can transpire in year 3 that might change the whole trajectory of that. But you still might have a decent margin of safety depending on what transpires within the next 3 years or so. Any other questions in the chat?
No questions, but there was a comment that said, but in 10 years, the business probably won't be around if the company's bad.
Now, when you say the company's bad, is more so you can have things that happen that might be bad for the image of the business, but that doesn't really affect how the business is ran.
Right, there might be a scandal out there or something happens and it could affect the price. You never know what it could be. Bad publicity, somebody says Copart done stole countless amount of money from people or whatever it may be to affect the price in year 4 and 5. And that'll affect the actual growth of it in those 2 years.
Yeah, but especially if you're not looking to hold a stock for the long term, then you really wouldn't even be worried about this if you're just trying to get in and get out. Because there's a separate evaluation or valuation for intrinsic value for options, and that's something totally different. But it's pretty much along the same line. But this is mainly for long-term investing.
And can you do NVDA? There was another question while you're looking that up.
Mm-hmm.
What margin of safety percent would you want to stay above?
Me personally, I hear a lot of things, people 25 to 50%. I try to go with the 35, a little bit more than 25. I'm more so 30 between 35 and 45%. I'm good. Anything above 45, I'm good. But sometimes, depending on what the business is, I might kind of move it down to, all right, 35%. I'll be cool with. It's really all on what type of risk each individual investor is looking to take on. Because what you might be looking at might not be the same interest that I have. You might be dealing with a different money bracket than I do. So it's up to the individual investor to set that up and determine that before they start looking at intrinsic value.
It's not your fault.
507.34.
After this one, Zoom, and then that'll be the last one. And just open up for questions.
Okay, what was I looking for? EPS 5.44. Like I said, these two numbers are going to stay the same again. Beta. $135. Industry average 29.22. And growth rate for NVIDIA. $17.44. And look, in the past 5 years is at 52.83. Next 5 years is at 17.44. It's a big difference.
Yeah, and I would always say go for the number
Average.
that's
Or
number that's average or lower.
make sure I got everything.
Correct. This is still NVDA. Zoom will be next.
Yeah, and they have the intrinsic value set at 208.15, and the stock price is currently 507.34. Margin of safety is negative, so you would see that the stock is overvalued.
And I'm assuming you'll get stuff like this when you have stocks that are getting a lot of hype right now,
Yeah.
and everybody's pouring into them, and it's just going, and people are assuming that it's going to keep on keeping on.
Now, let me see something. Let me just change this just for shits and giggles. Yeah, negative 2%, 30 years out. 493.97. And was the other one Zoom, you said?
Yes. Actually, do me one before you do that. Go back to that, and I'm going to do the average for the EPS. So what's that, 52.83?
Yeah, 52.83, and 17.44.
And plug in 35.13.
35.13.
Yeah.
And that's over 30 years right there. Let me go back to 10.
Okay, so it's
Intrinsic
still close.
5.7% margin of safety.
So in my eyes, me personally, I would stay away from this. Just too close to a 10-year projected price on the stock. 5% margin of safety doesn't sit right with me.
How about now?
I mean, that's cool. But so and the reason why I say that, if you go back to 10, the reason why I say that is just with it being so close, and if you actually watch NVDA, and yes, they will be the future, or they are, making that way for the future. They're just on a run,
But that's why these two numbers need to be reevaluated to why is it the past 5 years was at 52.83% and the
Mm-hmm.
next 5 years is 17.44. Those numbers are telling you that maybe it's ran up as much as it could in that time period. Doesn't mean that it
Exactly.
can't go further, but they're projecting, or their forecast is 17.44%. That's a large drop from 52.83%. So that's when that fundamental research comes in play, where you dig in to go back the 5 past years to find out what caused them to run up so high.
Exactly. Okay, we can do Zoom, and then we can open it up for questions.
Oh, dang it.
You're absolutely right. It does have to level off at some point to balance out.
Oh, sorry, okay. 289.68. .17. Beta. It's not showing up over here. Yeah, it's not giving me beta.
Isn't Zoom new?
When did the IPO? I don't even remember when IPO.
I believe it was recent. Hold on. Yeah, April 18th, 2019.
It should still have a beta for it. But yeah, they definitely haven't been in 5 years yet because they don't have the past 5. Well, there goes Zoom. But I'm pretty sure it's a way to calculate the beta for it. Well, if I don't know what the beta is, but the benchmark for the index would be 1. But you don't want to go ahead and play with that and put 1 in there and mess up your numbers when you don't really know what the actual beta is. But what was the other one you was gonna do after Zoom?
I believe that was it. Does anybody else have
it?
any stocks to do one more? Teladoc.
What's that?
Teladoc, TDLC.
Okay, I got the beta and the EPS. I got a negative EPS. $20. It's crazy. Yeah, this number's not gonna be cute. Negative 244.75. Yeah, I don't think it's gonna come up with the negative number. Uh, 24. It's not gonna come out with that number in there. So that's the only thing I don't like about this. With certain metrics, if the number's negative, especially for the industry growth, is definitely gonna mess everything up. Let's go see something real quick.
What was the only number you was looking for Zoom? Was it just the beta?
Yeah.
In the chat, it was said they found negative 0.07.
For beta,
Yeah,
where'd they find that at?
Market Watch.
But what was it? Actually, let me just do this real quick. So let's see if this should come out without that. 2, 2, 3, 4. Trying 12 months. Yeah, negative. Those negatives will mess everything up. And what was it? Negative 0.28. Yeah, when you put the negatives in there, it's gonna mess it up. It's not gonna calculate it. So what was the other one? The Zoom joint?
Yeah, so it's negative. So you said it won't calculate a negative.
Nah.
JKHY.
What's that?
I have no idea. It's a stock.
Jack Henry Associates. IT midcap. Okay, 0.5. How many? Okay. 65.85. Let me get this out of here. EPS 386. Beta. Industry PE. JKH. trillion in margin of safety for 4.8% over the next 10 years for the intrinsic value.
Somebody said, damn. I'm guessing you was hoping for a higher number for intrinsic value. But okay, cool. And remember, this is all estimates, so you never know. Even though that was only what, $10 off. I mean, hey. Does anybody have any questions? All right, cool. Well, hey, Sean, I appreciate everything. I guess you could do your little closeout if you have a closeout.
Nah, I don't have a closeout, man. Ain't nothing to close. It's the weekend and quarantine.
All right, cool. Well,
Nah, I just want to know if people found value in that and understand, you know, if I don't know if that was too much information in there, or if it was a good tool to have or something that you may have not seen before. Just let us know in the comments or just hit up Ty and let them know that, you know, something like this you would like, because there's a bunch of other valuation methods. It's just I chose this one because it's something that I was familiar with.
so here, I'm gonna go ahead and stop recording.